Good afternoon, and thank you for joining us for today's webinar, Liquidity, Staying at the Ready. My name is Sean O'Brien, and I am the president of QwickRate, and I am pleased today to be joined by Pam Cerrubi from our sales team. Pam, do you want to say hello?
Yes, hello everybody. Thanks for joining us.
Awesome. So today, just like all of our webinars, we will send out a copy of the slides and a link to the recording in a follow-up email, likely tomorrow. If you have any questions, certainly submit those through the chat feature or the Q&A feature, and we'll take those either in the midst of the conversation or presentation, excuse me, or at the end of the presentation. So let's just kind of jump into it, right? Really last year, liquidity came back on everyone's radar. I mean, it never really goes away, but I think, having been doing this for over 20 years, I think there's certainly times, where we feel like liquidity is always there until it isn't. And then we kind of have to kind of regroup and reevaluate, what we're doing and maybe where weaknesses might be, evident or resident in our institutions. I think last year, right, it brought a huge focus on concentration risk, in particular the level of our uninsured deposits. I think for the banks that had liquidity issues last year that failed, it exposed a real weakness, both in just overall risk management, but also underestimating the impact or the risk involved with overly concentrated deposits. And certainly those were exacerbated by the fact, where the inverted yield curve and the impact it had on securities portfolios, and technology, right? Just the sheer immediacy of those withdrawals really kind of made everybody take a step back, including regulators, and just, reevaluate, what we're doing with our liquidity policies and procedures. Certainly there were some lessons learned. I think there's some questions we should ask, but I think, at a minimum, we want to focus in on what those level of uninsured deposits are. We want to make sure we're in contact with our largest customers, understanding our potentially our single account or single, account type of relationships, and just, whether those are the ones we're willing to let leave. Establishing attrition monitors, just again, things to make us, a little bit more in tune with just the day-to-day ins and outs of our liquidity. I think these challenges, that we're experiencing and dealing with today will likely be with us tomorrow. I don't think, I think I've said this on the previous liquidity webinars, right? I just really think the whole Silicon Valley just ushered in a new era of liquidity that we're going to deal with for a long time, right? Just the ongoing pressures of one, attracting deposits, two, maintaining them, retaining them, dealing with fintechs, dealing with expectations for higher yields. All of those things feel like that they're gonna remain with us for a while, and as a result, it's going to present real challenges for us. But also, I think the other thing that came, and hopefully this one's not long-lived, but there is clearly currently, an increased focus, regulatory focus, on liquidity. So again, some more of the current realities, right? Hopefully we're at the peak of interest rates. We'll start to go lower, but they've certainly impacted our balance sheets. They've certainly impacted customer expectations. And they've certainly impacted our net interest margins. I do believe we're going to see, and we'll continue to see, just increased competition for every deposit. As you probably saw in my bio, I'm a director in a small community bank in Illinois. The liquidity issues, that were really, kind of front and center last year, right? They've subsided, but attracting deposits to kind of meet and match what our growth expectations are, right, is a real challenge, and I think again is going to continue to be a challenge for community banks, particularly ones like ours where you're in probably just one or two counties, and there's a lot of competition for those deposits. I think we've certainly seen across the industry a decline in non-interest-bearing accounts. That's probably a trend that continues. I think the inertia that for so long we may have in some ways taken for granted we can no longer do. Technology has made it very easy for our customers, even our best customers, to move money immediately or very quickly. And so we have to be sensitive to that. And I think, again, I think because we've come from an era where deposits were so plentiful, I think, we're probably getting a little bit of a sea change where I think maybe the stability of a deposit may be more attractive and take precedence for us over simply the price of those deposits. So, as a result, I think there's just a lot of reviewing of policies, kind of just the management of our funds. I think stress testing has come back a little bit into play. And again, I just think examiner expectations around what we're doing with our liquidity is certainly elevated from where we were just a couple of years ago. The Fed's meeting today or tomorrow, this week, I forget which day, but nevertheless, I mean, right, I think we're all probably, have moved to something that, where we think there might not be, hopefully a soft landing. I mean, it seems like that might be the outlook that the Fed has been trying to engineer. Where again, the rate of inflation continues to decline, not the overall level, but just the rate of inflation continues to decline. And we'll start to see a drop in rate cuts. Hopefully that does not, precipitate there's clearly be the unemployment rate will likely rise. Hopefully it's not too severe and cause, really over the top credit issues. But, I think these are probably the three ways to be thinking about, what's coming over the next 12 to 24 months. There's just really no easy decisions today, right? We are continually battling the challenge of trying to lower our cost of funds while managing, letting any deposit leave our institutions. And managing those relationships is, again, a challenge that we're going to be dealing with today and very likely into the future. So, again, I think what happens often in times like these is I feel like we always go back a little bit to the basics, right? We just kind of take a look at what we've been doing and really determine if that's in sync with where we are and where we're going. And, again, it all starts with, as with everything in a financial institution, right, was with our corporate governance by the board and management. So, revisiting, what our philosophies are, what our strategies are, what our policies, procedures, and limits are going to be, again, evaluating our internal controls to determine and monitor inflows and outflows. I think collateral increasingly becomes important as we have to potentially rely on the FHLB or the Federal Reserve. We want to make sure we're optimizing our collateral in the most effective way for us to generate any liquidity possible. I think the last few years with the rise in interest rates has really taken for many of us the securities portfolio off the table as a source of liquidity. Hopefully with the drop in rates, we'll start to see some of those, security, the AOCI adjustments go away, and then we'll actually be able to draw back that as a source of liquidity. But for the past couple of years, that's really been, kind of no help for us. And so I think it reminds us to have at the ready a very diverse mix of wholesale funding sources. So we're going to talk about, QwickRate today, but I think, you want to make sure you have as many available, ready, and tested sources of funding that you can, regardless of your size. And then, again, I think we dusted off our contingency funding plans to make sure they're, again, up to date and, able to be activated at a moment's notice. So when you think about, areas of focus, right, it really starts with, policies and procedures. I think one thing that often we've seen over the years is just really, kind of handcuffing ourselves by having limits on wholesale funding too low, limiting potentially the number of sources or partners, wholesale funding partners we might use. Again, you really want to have as much funding diversification as you can. Collateral is always important. I think with the Silicon Valley situation, the discount window for the Fed kind of came back into conversations. They recognize that there's always been kind of a stigma attached to using the discount window. They are certainly working to try to minimize that. I would certainly encourage all of you, if you don't have a relationship set up with the Fed, to do so. They do accept greater forms of collateral. So again, I think it's prudent for everyone to have that at the ready and tested, because as the Fed has indicated, that is not a overnight, kind of turn the switch on. It does take some time, so you're going to want to make sure you have that in place should you have any issues or just need additional sources of liquidity. As we touched on earlier, concentrations have increasingly become important, particularly around uninsured deposits. But again, refresh those policy limits and make sure you're not, hurting yourself by having those be too restrictive. And then again, stress testing and contingency funding. It's hard to want to do when there's no stress, but that's really the time to practice, if you will, to get a sense of a plan and making sure we're able to activate a workable contingency funding plan should we ever need it. So again, just I hate to keep going back to the Silicon Valley experience, but it did really change a lot of things that again we had started. I don't want to say take for granted, but we certainly had perhaps minimized, right? And so it's that focus on the uninsured deposits. It's the double-edged sword of technology, right? We all want to have the best technology. Our customers want it, but it does, again, as we talked about, allow for deposits to move at a moment's notice. And then again, if I can't emphasize enough, making sure that all of us are signed up for the discount window. Costs, as we touched on at the beginning, higher rates have really impacted our cost of funds and our NIMs. So, focusing and trying to seek out, new deposits. Sometimes it might be in your situation, better to try to overprice new deposits versus cannibalizing old deposits. Those are conversations that are unique to every institution, but I think those are the things, that we have to be thinking about. Looking at, our, again, the role wholesale funding is going to play. I wouldn't say we should compete FHLB versus the Fed. I think we should have both. And as we've touched on, we'll continue, just avoid restrictive policies. I'm always, thinking about liquidity and just how simple the definition is, but the ability to raise money quickly at a reasonable cost without principal loss, right? That's really what gets to go. And so when we're thinking about our framework, we do, as we mentioned, want to be flexible and inclusive. It always starts with our local deposits, which again has increasingly become more competitive. You certainly want to use listing services like QwickRate. We need to incorporate and have broker deposits, reciprocals, the borrowings, and then again, while not as much of a factor here recently, but hopefully our securities portfolios and cash can come back into being a meaningful source of liquidity. So again, just kind of listing some of these out, right? Local deposits, right? We're really going to focus 3 different areas: our retail, commercial, and public funds. With listing services, we're glad you're here today, and certainly thank you for working with us over the years, but we provide a tremendous source of liquidity, through QwickRate. Again, having DTC options available to you, having as many, borrowing options available to you, I think, again, is important. And then, certainly a number of ways the asset side of the bank's balance sheet can assist us. So, when you think about our local deposits, right, it's really how are you going to go to market and how do you track, right? I think increasingly we see banks employing digital strategies. I think, again, trying to, focus in on, households that, who have the ability to give us more money. How many single service household accounts do we have? Using tiers and relationships to determine pricing. So all of those things are going to continue to come into play. the commercial side and then on the retail side, right? We're trying to balance the human touch versus the digital options available. And then, certainly in our markets, we want to try to attract and retain as many public fund operating accounts, as we possibly can. And so I think for a lot of us, right, is it a question of playing offensive or defense or both, right? Because there's a lot of different things we have to kind of weigh when it comes to different strategies, right? With regards to CDs, again, are we pricing for new money? Are we trying to minimize cannibalization of our existing customers? Are we willing to overpay on relationships? Or are we willing to just take single serve CD customers? Really identifying amongst our customer base who really has both the capacity and the willingness or propensity to give us more money. I think a lot of times when we go to market, we send CD specials out to our entire audience, many of them, which may not really have the ability to give us more money. So again, are we, A, is it worth it? But B, is it a really effective way to do it? And I think always the toughest thing for us to do is just track the success and differentiating between, what's working, what's not, new money versus repricing of old money, really having a system in place to try to track that, either internally or the assistance of a vendor, can be really, really helpful. Again, so I think just continuing to focus on non-maturity deposits, I think will probably become, more of an area of focus. You will certainly want to try to create that perfect money market account. And then again, really trying to target our best customers who, again, typically, if they have high deposits with us, means they might have more money elsewhere, right? So really trying to focus in on who really our best customers are and who we might be able to get more money from them, and then just trying to figure out the best way to go out there and do it. Increasingly, that involves digital strategies. So if that's not something you're doing today, I think it's certainly something you want to be looking into. As we touched on, wholesale funding sources, right? Have as many as you possibly have. Confirm regularly that you have the ability to raise money. And then make sure you're documenting your policies and procedures to make sure, A, you're not restricting yourselves, but also anything else that might just restrict the use of as many funding sources as possible. As I mentioned, collateral is also important, optimizing that, but then also making sure we have systems in place, to manage, for most of us, it's probably monthly. But if we are in a little bit tighter situations, the ability to manage, weekly, daily, if necessary. And then again, just make sure we're on top of and actively deploying our collateral. I think once we're done with all this, right, it really comes back to what are we sharing with our ALCO committees and our boards. So probably a fresh set of eyes on what we're sharing, making sure they're up to date. Certainly there's things within Quick Analytics that we think can help. So we're always willing to assist or share with you what we're hearing from other institutions. But again, I think, just having a good handle on some, liquidity ratios and early warning indicators are helpful. Comparing those to peers is always helpful. So, an abundance of resources available within Quick Analytics. And finally, stress testing. Again, no one really likes to do stress testing, but it does, it does help. It does potentially expose weaknesses. It does potentially, give us confidence to how we'd operate or implement a contingency funding plan. So, it's best done when there's no stress, so we can make sure, we're on top of it. But certainly try to create something that's reasonable and relevant for your institution. Again, I think a lot of times, we think more about systemic stresses, but I think for us, a lot of, institution-specific stresses can be helpful. And things you might want to consider are, any potential haircuts to securities, the ability to borrow money, and just what the mix of liability options that we have available to us. Again, I think the contingency funding plan, again, if you haven't dusted that off in a while, just refresh it. Make sure the policies and procedures, still make sense. If you have a big AOCI, I think we want to certainly speak to that. And then again, I'm going to reemphasize just have the capacity to go to the discount window should you need to. These are just a couple of examples of some contingency events that you could use to incorporate into your stress scenarios. Again, I think these are things that we have certainly seen banks use over the years, and just thought it'd be helpful to share a few of those today. So just a few final thoughts before I turn the presentation over to Pam. Right, I think it all starts with just going back to our own banks and our own balance sheets. Continue to try to, as best we can, maintain discipline with both loan and deposit pricing. We've talked a lot about deposit pricing today, but loan pricing equally important. This year, when we did our kind of annual review of high performing banks, efficiency ratio is always the most important metric. But this year, loan pricing was really one of the most highly correlating aspects of performance. And so again, our customers are always asking for better loan and deposit pricing, but we do have to try to pass along the price increases that we need to make sure what our balance sheet is calling for. Revisit those really all of our liquidity management philosophies and policies. We have to be prepared for rates going lower. And again, I think you can I think we also have to a little bit, we talked about earlier, there was a slide on just the lending conundrum, right? I think for a lot of us, if we do get a soft landing, again, we're going to start to have to balance our ability to continue to grow with what our potential liquidity constraints are. So again, I think getting out in front of that and thinking about what the next 12 to 24 months might look like is critically important. And then finally, again, compare yourself to your peers and certainly continue to work on and improving any communications with ALCO committees, management teams, and our board of directors. So at this point, all of us know how challenging organic deposit growth is. I'm going to turn the presentation over to Pam, who's going to talk a little bit about QwickRate. Pam, the screen is yours.
Okay, great. Thanks, Sean. Let me go ahead and share my screen then. Got presentation up as well. I hope everybody sees that.
Yep, I can.
Okay, great. I'm going to talk a little bit about, of course, the QwickRate Marketplace, what it provides. We're going to stay, very high level here, but just want to give you a feel for what it is, how it works, how it may be able to help your bank. Couple points here. First thing is you can use it on both sides. So QwickRate is a subscription-based service. So as a subscriber, you have unlimited usage on both sides. So, some of our banks, the majority of our banks use it for funding as a alternative funding source, of course, bring deposits in. Some will use it because they have a lot of excess liquidity and they want to do some investing directly with banks out there in the nation. Some use it on both sides. So you have unlimited usage on both sides. So that's really what we want you to know. Of course, we're going to focus on the funding side today. QwickRate, if you're not as familiar with us, we were founded over 38 years ago. We've been around a long time. Over 2,800 institutional subscribers. QwickRate is made up primarily of other banks and credit unions. It is a closed institutional marketplace, so there are no consumers or individuals. I know Sean mentioned cannibalizing the deposits you already have, which is obviously something you need to pay attention to. One of the nice things about QwickRate is it is a closed institutional marketplace, so your local market will never see the rates that you have out on QwickRate. So it does give you a controlled audience. QwickRate is also a preferred service provider of the ICBA. We have been since 2002, so we're pretty proud of that. And then what I'm going to do now is I'm going to actually take you out there live to the marketplace. Let me share another screen here real quick. Okay, I am logged on live, so we're going to see current banks, current rates that are out there. This is what we'll do if you contact us. If you do want to find out more about QwickRate, highly recommend you schedule a demo. If you go to our website, there's a little button that says get a demo. You can click there or just send us an email. Sean will share some contact information with you in a little bit here, but the best way for us to show you how it works, to see if it's, a good fit for your bank, provide provide pricing, obviously, but also answer any questions you have so you can see if it's a good fit, is to schedule a demo, which usually lasts about 30-45 minutes. But today we're just going to look at just a few screens and give you a feel for what it is. First screen I want to take you into is view rates. If your bank is posting a rate to bring deposits in, this is where you're going to appear to the investors. So the investors will come into this screen. They'll sort by whatever term they're interested in placing in. So in this example, you can see all the standard terms here, 7 days to 10 years. You can also post an oddball bucket if you want to bring in. This bank has a 23-month CD they're offering, but we're currently sorted by the 1-year term. You can tell because it's highlighted. So what we're seeing here are the banks that are out there, the rates that they're posting. Again, we are logged on live. We have entered kind of a dummy investment portfolio to show you what the investor sees. So one of the other things you want to know about QwickRate is that even though these are institutional investors, you'll 99.9% of the time, you're going to see, 245,000, 249,000, just under the insured amount, because what they want to do is place as much with each bank as they can without going over that FDIC insured amount. And of course, all of our banks have to be FDIC insured to post a rate. So the good news for you, if you're bringing deposits in, is you don't have to be the top rate to attract attention. You just have to be the next bank in line that they're not already placed with. So if you see these blue check marks here, that's that dummy investment portfolio that we've entered. To an investor coming to the screen, he knows that any blue check mark banks he's already placed with, so he's going to skip over those. So we can use the example of an investor, say they have $1 million today that they want to place in the 1-year term. So, for example purposes, they need to find 4 banks. So this first bank open to them would be this Bay Bank. I'm going to go ahead and click on their name. When your bank is posting a rate out here, this is the information about your bank that will be provided to investors. So of course, who you are, where you're located, your insurance number. Again, you have to be FDIC insured. Minimum maximum deposit you'll accept, although, I don't want you to expect large blocks. You could put $1 million here, but the reality is they're all going to keep them at 250 or just below. Of course, things like how you pay your interest, and there's certain things we'll recommend to you if you do a demo with us, just to keep yourselves more popular with the investors, of course, but this is up to you. We don't dictate that. Your wire instructions. These investors will wire the funds directly to you. We don't get involved in that at all. So of course you do provide your wire instructions for them, but also a wire in and out time. Another thing about QwickRate that may be different from some other funding sources you use is there is no settlement period. These are same-day transactions, but you will let the investor know. In this case, this is very precise. This bank says 4:55. So is their wire in time, telling that investor, if you wire me the funds by 4:55 Eastern time, I'll book that CD as of today. Otherwise, it's going to be the following day. And the same with the wire out time. So that's just letting the investor know, that's our cutoff time. The last thing that's provided would be a snapshot of your financials. You don't have to provide these to us. We get it directly from the FDIC. Of course, they're updated quarterly. These are for the investors if they want to see what the financials are. So that's everything that's out there about your bank when you're out here posting a rate for funding. Now, to show you how the investor behaves, again, my example was, they need 4 banks today to place that $1 million. So what they're going to do is, again, skip over the check marks, go to the first bank, open to them, the second bank, the third bank, and the 4th bank. And what they're doing is just putting these in their rate card. So they're going to skip over, make sure they don't double place, and send an inquiry to the top 4 banks that are open to them. I'll show you what that looks like. Once they've done that, if they're ready to go ahead and send inquiries, they just go to their rate card. It's just like shopping online for them. They will put the amount they want to place with each bank. Here are the 4 banks they've selected. Then they'll just select which ones they, say, yes, I do want to send these inquiries, and they'll click a button that says send inquiries. What that does is it sends an email to whoever on your end you've given that role to that says, hey, you have an inquiry. Log into QwickRate to respond to them. There's no communication done via email. excuse me, because that's not a secure method. Everything will be done through the marketplace. It's just notification emails you'll get to say, hey, you have an inquiry, so you don't have to sit and stare at the screen all day. This is designed to be a totally paperless system. So you shouldn't have any phone calls, faxes, things to mail out, anything like that. Everything should be conducted within the marketplace. But you will get an email saying you have inquiries, so you'll know to log in and respond to them. Now, this is where I can't take you live because I'm not a bank or credit union. So I'm just going to I'll show you a couple screenshots of what that looks like. If your bank gets an email, says you have an inquiry, you'll be prompted to log into QwickRate, go to your inquiry screen, and this is an example of what that looks like. So in this case, this bank has 4 inquiries that have come in. We'll go to this first one. We need to respond to them. And this is where you get to see who the investor is, the term, of course, the terms you've set, the purchase end date is by the term that you've set it for, the amount the investor's filled in, and the rate, of course, is what you're currently posting. But you'll see the information about the investor that you need. Another nice thing about the QwickRate Marketplace is that because the other subscribers, the investors, are going to be primarily other banks and credit unions, they're federally regulated institutions, they're exempt from the CIP. So you need very little information from them. And what you need is already attached to every inquiry you get. So, of course, you'll know who they are. You'll have their contact info in case you need to reach out. But again, that you rarely should need to do that. But it is there for you. But also their documentation is attached. What you'll need from these types of investors is a copy of their W-9 and their corporate resolution, and that's it. And that will already be attached to the inquiry. When our customer service department sets up an investor, they make sure those documents are attached before they flip the switch so that they can send the inquiries. And that way you already have it. You don't have to chase it down later. So if you decide to accept it, you'll have what you need. And to respond to them, you simply click accept or decline. You're never obligated to accept a deposit on QwickRate, even if you have rates out there, but you will need to respond to them. So if we accept this, what happens is it sends an email to the investor on the other end that says your bank has, accepted their inquiry, and then they can log in, to get the information and handle the rest of it. This is an example of, again, that inquiry screen where you've accepted that first deposit. The last thing you need to do is, once you've accepted it and the investor has wired those funds to you, again, they wire those directly to you, you'll want to close it out to get it out of your inquiry screen, and you'll want to create the safekeeping receipt. That's the last piece that you'll need to send to them. Really only piece, I guess, in this case. And you just select them here and then click post and create safekeeping receipt, and then you're done. That safekeeping receipt is a merge document during your training with customer service when you come on board, which usually lasts about 45 minutes to an hour. It's very easy to get up and running. But during the training, one of the things they're going to do is help you customize the safekeeping receipt. You do it once and then you don't have to do it again. Most of it is a merge document. It knows who you are, the investor is, the terms of the CD, of course, the rate you're posting. But things like your early withdrawal penalties, they'll help you enter those. And then once you've done it once, you're done. So once you click that button, the investor just goes and gets it. You don't have to send them that receipt or, by mail or fax or anything like that. They'll just go get it. So it's pretty easy conversation between you and the investor. Again, all done directly and all through the system. The other screen I want to show you today is publish rates. This is where you go to actually put your rates out into the market. So in this screen, we have some tools in order to do that. One of the first things I recommend, though, is go to this little yellow Post-it note. What this is going to show you is some insight as to where the activity's been happening. So if we go here, since this is currently September, we're going to see last month's activity. You can drill down deeper if you want to look at a particular week, but usually monthly is a pretty good indicator because it doesn't change drastically, and that gives you, if there was a holiday week or something, it might skew the numbers a little bit. But what we're looking at here are all the standard terms and then the activity that happened last month for those terms. So you can see the one-year term is the most popular, always has been. But so you'll know in these more popular terms, say traditionally 6 months to 2 years. Of course, right now, you can see the 3 years a little more active, 30-day, there's a little activity, but not much. So you can be less aggressive in the terms that are more popular. But we'll drill down a little bit more and you can see a little more detail on that. We'll go into the 1 year. So in that 1 year term, where was the money placed? So this screen is going to show you positions. And when it's referring to position, it's literally talking about that first screen we looked at. So positions 1 through 10 is going to be position 1 is the top bank on the list, second bank on the list, third bank, and so on. So that's what position is. So it's telling you in the 1 year term for August, positions 1 through 10 had this much activity, 11 through 25, this much. And there was even a little bit beneath the 50th position. This will change by environment. So you definitely want to be familiar with where the activity is happening so you know about where to position yourself, depending on what you want to accomplish, of course. If we look at, say, that 30-day, the one where there wasn't as much activity, this is where the activity happened. So there was no activity beneath the 25th position, you know, on the second or third page there. So if you really want 30-day money, you're going to have to be much more aggressive. But that, again, is just for insight for you. We go back to publish rates. We have a tool called Edit Rates by Market Position. This is really the easiest way to set your rates. What this screen shows you is all the standard terms again. Rank is position. What position do you want to be? Best is the top rate, 10th in line, and so on. So if we look at those popular terms, let's say you're going to post a rate in several, which we definitely recommend. It gives them more places to find you. And we're telling QwickRate we want to be in the 15th position. And we really want some of that 30-day money, but it's not popular. So we're going to say, put me in the 5th position. So you just tell QwickRate what position you want to be, and then click the set position. It's going to go analyze it, come back, and give you a recommendation. You haven't set these rates yet, but it's going to make a recommendation to get you as close to that position as it can. In this case, we asked to be 5th, bumped us up 1, 12, or 15th, it bumped us up to the 12th, and so on. But it's also going to break you out of the majority of the ties. So, for example, we'll take this 180-day, it put us 12th. We wanted to be 15th. It's added on that 100th of a basis point. If you take that off, you say, yeah, I don't really want to mess with that, and then ask it to analyze it again. What happens is, today, if you were to just post a 4.90, you'd be tied with 5 banks and you'd move up to 17th, or sorry, move down to the 17th. So it's just moved you down the page 5 places. And really, by adding that back in, you're not paying anything more for that deposit. So it does jump you up the page. It can make a difference on the response you get. So definitely a great tool to use, and, you know, when possible, take its recommendations. But once you're happy with these, you're ready to put them out there. It's pretty easy. Start and end date will default to a week. You'll always need to put in a start and end date. It can be 1 day, 7 days, 10 days, whatever you want. But what happens if you do nothing else and that end date comes and goes? Your rates will just fall out of the market. But you can come in at any time. If you post your rates for a week and in 2 days you go, you know what, I brought in all I want, I need to lower my rates, or maybe you started really low and you're not getting the response and you want to bump them up, you can come in at any time and modify these rates. But you will need to set a start and end date. The other thing you'll need to decide is, do you want to set a holding limit? Now it's going to default to none, but it can kind of watch things for you behind the screen if you want it to. So you have a couple options. You could set it per term. Maybe you went in 30-day, but you don't want a lot of it. Let's say you're trying to bring in 10 million, but in the 30-day, you're like, look, if I get 2 million, I want you to do something. I want you to send me an email so I can log in and change those. I want you to just take that particular term, those rates right out of the market. The rest will remain unchanged. Or, you know, I'll stay out there, but lower it by 50 basis points, kind of like your lobby rate. If I get something that cheap, I'll take it. So you can tell it what you want to do by term, and you can set different parameters for different terms. Some of them you can just leave open. The other option you have is to set it by total. You might say, I don't care what term it comes in, but I'm looking for $10 million. So what you're telling QwickRate is, if I get a mix of 10 million in any terms, I want you to lower my rates, my rates by basis points, or send me an email, or just remove them from the market. So you can set that if you like. Some banks just don't set a holding limit. They're watching it. They'll react when and if they need to. Once you've decided what to do there, though, you just click post. And of course, I can't do that. I'm not a bank, but then your rates are out there. So they're very much real time. There's no processing time or anything. So when I say you can come in and out anytime you like, you can certainly do that very quickly. And again, you're never obligated to accept it. So if you got in all the deposits you want, everybody went to lunch, you forgot to remove your rates, you got an inquiry, you can always just decline them. You also have the ability to post rollover rates. You can segment your audience, and rollover rates will only be seen by those institutions that have CDs maturing with you. So sometimes that's helpful. But those are really the two screens I wanted to show you really quick. We have all types of reporting and tracking and tools in place for you. And again, we'd be happy to show you that. If you want to schedule a demo with us, we'll be able to take a deeper dive there.
Pam, we had a question come in.
Sure.
How long does it take to become a QwickRate subscriber and start accepting deposits? Is there a new subscriber vetting process?
The time frame is really up to you. On our end, it's very quickly. As I mentioned, the training lasts 45 minutes to an hour. They do it online. Our process is we have a 2-page agreement. 1 page is pricing, which we would have already discussed, and the other page is kind of a standard license agreement. That's something we email to you. You sign it, you email it back, and then we can get you authorized and get your training scheduled. Well, you'll get an invoice in the mail to pay from, so we don't need that to do. We just need a signed agreement. Then customer service will contact you to schedule that training. The only other thing we need from you, if you remember on this first screen when we went in and there was information about your bank, the contact information, how you pay your interest, your wire instructions, we will have to have that before training because we have to get you set up to post a rate before we can allow you to do that. Again, it's just like one sheet. It's an account setup form. So, I mean, if you can turn it around very quickly, which I can't imagine it would take an hour or less, then we can get you trained usually within a day or two. So you can be out there pretty quickly. It just depends on how quickly you get things back to us, but our process is real simplified.
And then the second one is I'll take a stab at it and you can add any color to it if you want. But do any potential changes in broker deposit definitions affect the classification of listing services as non-brokered? No. The answer, Mike, is no. The comments that are out there that the FDIC is asking about is really to try to rein in some of the more expansive use now of broker deposits. Nothing's really impacted us at all. I mean, we have been and continue to be and remain a non-brokered listing service. Again, most of the deposit changes regarding broker definitions were regarding exceptions. And ultimately, we don't control the money, and that's really one of the major components now of what a broker deposit is, placing on someone's behalf or having control of the money. And obviously, QwickRate is a direct marketplace between you and the investing institutions. Pam, Al, if there's anything to add, I got a few more questions. I had the same question come in, and then are fees based on asset size and or activity?
Yeah, and as far as the, I don't really have anything to add on the broker deposit definition, but one of the things I'm going to tell you, I'm going to pass it back to Sean. Just want to remind you, unlimited funding investing. So as a subscriber, there's no limits on your usage. Regulatory guidance. My next slide is going to be introducing you to Debbie Walker, who's our Director of Regulatory and Compliance. And any of those types of questions, we can certainly answer most of them, but she's always available to you if you need it. She has a lot of information out there online, which I didn't go into, but kind of frequently asked questions. And there are several about the classification of the deposits. And she has a lot of documents she's put together, links to the regulatory agencies, and their particular opinions and information on that. But she's always available to you she's not on the chat feature, but by email, by phone, I can set up an appointment or to talk with her, but you can always reach out to her and she'd be happy to help you on any of those things.
Yeah, and I think that's a really good point. If you want specific information, Debbie, as Pam indicated, has a long library of information regarding our non-brokered classification, and in particular too, just even these new areas that were put out for comment. But bottom line is, we've been non-brokered. We will continue to be non-brokered. Nothing that they're discussing impacts or is even really reflective of listing services. We are what we have been, which is a non-brokered source of funding. Back to pricing. We usually typically do price based on asset size. So again, that's something we're happy to discuss with you in a follow-up session.
Yeah, absolutely. You can just reach out to us, and ideally we'll have a chance to do a quick demo with you and we'll discuss it then, but you can always just shoot us an email, and whoever the correct bank representative is will contact you. It may be me, but it may not. And then last thing here is just unlimited customer support. You do have unlimited support, which includes training. If we train your initial users and you have a new user down the road, we'll train them as well. Our customer service is phenomenal. You can reach out to them via email, you can call them, or a lot of our customers like the chat feature because they're always there. If you're on there, have a quick question, they'll pop in and help you with that. So they're amazing. And there's no other costs or anything. The only cost is a subscription cost. All of this is just part of your subscription. Oh, here was my next slide. Yes, these are non-brokered. And then this is Debbie. And she's also, just want to mention, she's written a risk management workbook and also sample policy templates. If this is a new area of funding, or you just need to revisit your, funding policy templates, or funding policies, her templates are very helpful. There's no cost associated with it. Of course, it's only for our subscribers, but there's no cost. She'll provide those to you. No problem. And then with that, I will hand it back to Sean.
Okay, thank you, Pam. And yeah, as Pam indicated, Debbie just has a huge resource of things that she can share with you if you're looking for any assistance regarding this as a funding source. So, all right. So, again, really, we've been doing this for 38 years. So, we have a long history of being a stable source of funding for and investing for our subscribers. So certainly encourage you, as Pam indicated, to get a demo if you're unfamiliar, if you want to learn more, and we'll be happy to do that. Just a reminder, certainly a lot of you have been on other quick analytics calls, as we touched on in my part of the discussion. There is liquidity risk reports, and just in your My Bank data, helpful information around your deposits as well. For those of you who aren't familiar with IntelliCredit, again, we provide loan reviews, but we've also built an application that can assist you with both annual reviews, internal loan reviews. We have recently added a loan level stress testing service as well. So as part of a loan review, or even in an individual offering, we can assist with loan level stress testing, which is a complement to the portfolio level credit stress test we have in Quick Analytics. So again, trying to really round out our level of services with IntelliCredit. Any questions, go ahead and again, submit those now. Let me just make sure I haven't missed any. So again, just submit through the chat or the Q&A. Just again, some nice comments from customers of ours. We really have been able to assist institutions. We're very proud of the track record that we have. And so as Pam indicated, we'd love to talk to you about your situation. Reach out to us and schedule us, a demo at QwickRate.com. Give us a call, email us, join us for a future webinar. But yeah, really happy to help you in any which way we can. Pam, any final words for everybody before we let them back to their day?
I don't think so. Just thank you so much for taking the time to learn more about this, and hopefully we'll talk with you soon.
That sounds great. Just a reminder, we do have a couple of additional webinars coming up. Next week, we have a webinar on growing gaps in your strategic plan. And then we also have our CECL Coffee Talk on the 27th. Again, email us for questions or request a demo at info@quickrate.com. Certainly thank you all for taking time out of your day to join us for another webinar. Certainly happy to help you, and hopefully we can help you if we're not already assisting you. And if you have any questions, go ahead and reach out to us through the 800 number or through the email. You see, there's just one more question. I am interested in comparing. If you can reach out to Debbie Walker or your sales representative or service, and they can help you with those, get you a copy of those policy templates. So the question was really about, comparing their policy templates to our policy templates to their current policies to make sure we're not missing anything. So again, you can reach out to your sales representative, reach out to customer service, to Debbie Walker, or again, just email us at info@QwickRate.com, or call us at the 800 number, or chat with us, and we'll get those policy templates out to you. Okay, let's see. I don't see any additional questions. Thank you again all for joining us, and I hope you have a great day. And again, appreciate you joining us. Bye now.